Income Tax 2020. Tax software example, Schedule C, depreciation. Come in, relax with Income Tax 2020. Here we are in our Intuit tax software. You don't need the Intuit tax software to follow along, although I do think they have a 30-day free trial. So if you can get access to a demo version to practice with, it could be a good tool to do so. We're going to be working in the Form 1040 and the related Schedule C, jumping back and forth from the data input to the forms, the tax software making it easier for us to do so. Our starting point will be, we have the single tax filer, that being Eric Smith, living in Beverly Hills 90210. We have the 100,000 that's feeding in from the Schedule C, which we will take a look at shortly. We then have the half of the self-employment tax, which is the above the line deduction, to get us down to our adjusted gross income. We've got the standard deduction, $12,400, not related to the Schedule C, but because it's a single tax filer who is not itemizing at this point. And then we have the qualified business income deduction, which is not our focus at this point. Our focus is on the depreciation for the Schedule C to get us down to the $64,428 taxable income. Let's take a look at the Schedule C. So if we go on over to the Schedule C, we are focusing down on the expenses items, and we're focusing in on the depreciation. So the general rule from a practical standpoint in terms of data input is that if we have something that's going to be benefiting multiple years, and that typically means that it's going to be a larger dollar amount item, so you might think of a dollar threshold, although that's not kind of the driving factor. Usually the driving factor is this something that's going to be impacting multiple years? Then we shouldn't just put it on here as an expense. For example, we're not going to have something like a forklift expense on here. That would look funny if you bought a $30,000 forklift and simply expensed it, even though you might still be able to basically expense the whole thing, but we need to do so in the format of depreciation. And why would we still get to expense the whole thing? Because we might have accelerated depreciation methods. We might be able to use bonus depreciation or Section 179 depreciation, but those kind of laws kind of come and go in terms of whether they're going to try to stimulate the economy more. And so we still have to go through the process of putting it on the books as an asset and then depreciating it, possibly being able to depreciate the entire thing. So anything that's going to be over a certain threshold, then we're thinking, okay, now is that something that I have to put on as a capital asset and depreciate, or is it something that I can expense that'll typically be over a certain dollar amount oftentimes that you'll be considering these things, and there'll be things like equipment and whatnot that you'll be dealing with. And then, of course, you want to think about, can I apply the rules for, say, bonus depreciation and 179, which would allow me to deduct more in the current year, which is usually a good thing. So if I go back on over and we're going to say, okay, let's enter our deductions. I'm going to say that we want a depreciable asset. So we'll put this into the depreciable asset. Also, just know from a logistic standpoint that if you have depreciable assets from a prior year, they could, of course, affect the current year. And that is information that should hopefully roll over from the software, meaning if you did the tax return in the prior year, when you roll it over, the depreciation should be calculated on the prior information because it'll be in the software. However, if you have a new client that had their taxes done in the prior year and they have depreciation involved, then you're going to need to enter the prior year depreciation information in. You could do that into the current year software, but I would recommend, if possible, because that's going to be a bit more complex of a return, to enter that data into the prior year tax return. For example, enter the taxes for 2019, check your data, get a feel for the tax return, pro forma it forward, and then all prior year purchases of fixed assets should roll forward with regards to the depreciation, and then you can enter the current year information, meaning purchases that happened in the current year. So notice that the categories over here can kind of help you out to determine what category that we should be listing in, and then we'll often have the methods, which can also give us an idea of what to be included. So if I go into the 5 years makers, for example, we got the office equipment, the rental, the rental, and the furniture and fixtures type of equipment. If we go into then the 7 year, that's where we have the office furniture, the fixtures, and other property. So those are going to be the common kind of two things that we'll be dealing with. Note that we talked about the automobile and a car in a prior presentation, so I won't be focusing in on the car. There are some special rules and limitations related to it. So let's start with furniture. Let's say we had office furniture. And just note that as you enter this into the system, I'm putting a generic name of office furniture, which you should not do, because what you should do is make a specific name. And if you buy different pieces of furniture, say if you buy 5 couches at one time or something like that, then you would like to enter actually 5 couches into the tax software and depreciate them separately. And you might ask, why should I do that? Because it takes more work to do the data input. It's going to be basically the same in terms of the calculation this year. That's true. But in the future year, when you dispose of the sofas or possibly sell one, then if you have them all grouped together as one lump sum, that's a problem, because now you gotta sell like a portion of it, and you have it all in one line item. So what you want to do is break out the items as much as possible and look forward to the time period when they will be sold or disposed of, to make it easier at that point in time to take them off the books. But right now we'll just practice the depreciation. Now the form we're going to have is going to be the Schedule C. We're going to say this is going to be supporting service. Now the category then, it's furniture, so we're going to put it into the furniture and fixture. Categories being automobile, furniture and fixture, machinery and equipment, building, improvements, land, miscellaneous, amortization. These categories will help you to determine the methods that are going to be used for the depreciation. So I'm going to say, not machinery, I had furniture. And the date, I'm going to say we bought it, let's say on 03/15/20. The cost, let's say it was $10,000 for the furniture. Now I'm not going to put anything for the 179. It should help us to deduct or see whether or not we can apply the 179 or the bonus depreciation. So I'll let the default run on those. Then now here, note, we don't have a lot of leeway. We have more leeway oftentimes under generally accepted accounting principles to determine, say, the salvage value and possibly the depreciation method we're going to use, straight line or double declining or some other type of method, and the useful life of the thing that we are determined here. Here it's more stringent. The code determines those things. And the fact that it's furniture and equipment basically means that we got to take either the Maker's or a straight line method. Maker's accelerated method or Maker's straight line method is typically what we will be using. And it should be the 7-year property because it's furniture and fixture. So it should be we should be able to basically determine within the code, based on what we purchased, what the method will be used to be depreciating it. So I have the option basically here of depreciating it over 7 years. We pretty much kind of have to depreciate it over 7 years. We can't say, well, I think it's going to last 10 years or something like that, because it's in the category for taxes. I'm not going to go into that in a lot of detail, but just note it's a little bit more rigid than you might find in generally accepted accounting principles. We could then do the straight line method under Maker's as well. Maker's is pretty similar to double declining straight line. There's basically a half-year convention to it, meaning it'll assume that we purchased it not on 3/15, but 6/15 generally for the most part. So let's keep it at that, and let's see what we have then thus far. If I go back on over, we're going to say now we have the depreciation. Notice the entire $10,000 is there. And you might say, well, that's what I bought it for. Why didn't I just like expense it as like furniture expense? You know, you could have, basically, the way the code is right now, because the code is basically having these bonus and accelerated depreciation that allows you to basically expense the entire thing at one time. But those kind of things could come and go. So we still need to basically capitalize it and depreciate it, even though we might get the full depreciation here. Now, you also should have the depreciation schedules down here, which will give you more detail. So here's the depreciation schedules. It's saying we have the office furniture. This is the date that it was acquired, the cost basis, and then notice it gave us this special depreciation allowance. That's why we got the whole thing, because we got this special depreciation that it took. If we had not taken that, we would be using the 200, indicating double declining half year. That's the HY convention for a 7-year life. That means it's fully depreciated. Nothing's going to happen next year. We took the whole expense in the current year. Also note that you might have a difference between book depreciation and tax depreciation. And you should really, because the books should actually record the depreciation over the useful life, because that's better for the matching principle for us to see how well we're doing. But many small businesses will basically be on a tax basis oftentimes, because they don't want to be having 2 sets of books. And if it's a sole proprietorship, then you might just have basically the income statement that you're basically entering here and then entering the balance sheet items of the assets that were purchased. But if they do have a separate book amount, then you can record it here and say, I want to record a separate depreciation for the books. So I'm going to go down and say, now for the method for the book depreciation, we're going to say I'm just going to go straight down to straight line depreciation right here. And then I'll say it's 7-year straight line, but I don't want to apply, 179 or any special bonus depreciation or anything. And then I go back on over, and then we could say, okay, that's what it is for taxes. We're going to take the whole thing. But for book depreciation, it did what we would basically expect it to do, and it took the 7-year property and we recorded it at the straight line. So we can do that for our client. We can say, okay, we're going to give you the book depreciation for your books, and we're going to calculate the tax depreciation separately using the tax code to get as much tax advantage back in the current year will be typically the case. Now again, these are the schedules that you would need if you're doing the tax return first time for a client that came from another tax preparer. You'd need these schedules so that you can enter the prior year data into the current year system and get any current year depreciation from prior year purchases in the current system. Once you already have prior year information in the system, then you only have to worry about purchases and disposals to clean up your depreciation schedules. Also note that as we do this now, it looks pretty basic because we're just entering a few in the first year. But if this business was in business for 10 years or something, these depreciation schedules get quite long, cumbersome, ugly, to be dealing with. So that's why you want to be careful with them and build them well, meaning you don't want to put just office furniture like I did here, but list the actual furniture, list out separate pieces of furniture, put numbers that are gonna identify the furniture, easy to do, so that when you dispose of them, that'll be easy process to do as well. So if I go back on over, then let's now say we're gonna utilize the section 179 deduction, and so we had 10,000 in the 179 deduction, and go back on over, and now we see that we have the cost basis on the regular tax, and now we're in the current 179 depreciation that has been taken. And so once again, that would fully take the depreciation. If I go back to then the Schedule C, we still have the 10,000 in the depreciation down here. And so if I go back on down, that's going to be that one. Now there could be some differences in terms of the 100%, like the bonus depreciation or special depreciation, and the 179. There are different caps in terms of when you can take one or the other, but for many sole proprietorships, the caps, they probably won't be hitting the cap for small businesses oftentimes. There also the special depreciation, you could have used property, which could be a restriction for the 179. So again, if I take off the 179 and go back on over, taking off the 179, so we're back to the special depreciation there, okay? Let's try taking then, I just want to see the double declining balance. Let's say we don't have any 179, and you typically would want to normally take the 179, but I just want to look at what the normal maker's method would do if we didn't have it. And there might be circumstances where your income is really low, and if you don't need to take the accelerated depreciation, it might not be something that you could want to do at that point, because you might be able to get a bigger benefit possibly in future years when you have a higher tax rate or something like that. But I just want to take a look at the 179 or the maker's calculation at this point if we didn't have any special depreciation or 179. So I'm going to override it here and say no special, and then go back on over. So now we're not taking the 179 or the special, and we see it's calculated just normally if we just had the maker's depreciation, which is a modified double declining balance method. Now the thing about the double declining balance is you typically front load the first year, but it also has a half year convention, which basically means the first year goes back to kind of like the straight line method because you doubled it and then it went back to the straight line. But the second year will kind of be on double declining. So the fact that you have a half year convention can kind of confuse people in the first year. So we would basically have the 10,000, and if I divide that by, or let's do it this way, if I said that we had 1 divided by 7, that would give us the straight line rate, and then I'm going to multiply it times 2 to get the double rates for the double declining balance times the 10,000. So that's what you would normally think would be there for the first year if you had an entire year, but you only have half the year. So if I take that and divide it by 2, then that's going to give us that 14229 about, which basically brings us to the straight line method, because if I took that 10,000 divided by 7, you get to that same number. But don't confuse this with the straight line method, because the second year will not be straight line. It'll be double declining for the second year. It's only matching the straight line in the first year due to the fact that we have this half year convention. So we doubled it and then we brought it back to as if we purchased the asset in the middle of the year, even though we purchased it, in this case, in March. All right, so then if we go back on over and we were to add another piece of equipment here or something else, let's say that we have another kind of category. Let's go to the method and say we have 5-year property, which is the other common property, which would be office equipment, the rental, and then the furniture and fixtures. So let's say we bought like computers. Let's say we bought 2 computers, and this time I'm going to put it on a computer, and I would put maybe the serial number or something like that on it, maybe the make and model of it. And say we bought 2 of them for $1,000, we would want to list them separately. So again, once we sell them, we can pick them out and sell and take them off the depreciation schedule, which is often the more difficult part. Putting them on the depreciation schedule usually is the easier of the two. So then I'm going to say this happens on 10, let's say 10/01/20, and so I'll put this on for let's say 700, and the method here is going to be usually we will use the accelerated method if we can. Again, if you wanted to have a longer depreciation method, possibly delaying the depreciation, you might then use a straight line. But usually you want to take as much deduction as soon as you can, and the accelerated methods will do that. And so we'll have that, and then I'm going to say this, we have another computer, let's say like a second computer, and then we'll put the code for that one. And again, I'm imagining we bought these at the same time, 10/01/20, and we paid $1,400 for it, but I'm putting them both on the books so that when I sell them or dispose of them, it'll be easy for us to then go back and do that. So if I then put those 2 on there, we're going to go back in and we'll say, okay, now we have 2 categories. We got the furniture and fixture. Then we've got the computer, the machinery and equipment, which is the office equipment here, for the 700 to get us to the 14. And once again, we took all special depreciation. So the whole amount of the 11.4 then is something that maybe, or I'm sorry, this first one, I still have removed the depreciation. So let's put that back. I'm going to put that back and take the special depreciation on all of it. So special depreciation, remove the override. No more overriding. So now we should get the full 11.4, which should flow into the Schedule C. And there's the full 11.4 under the depreciation. So those are the main couple things that you'll have in the depreciable assets. When you're doing the books for the clients or entering the taxes, then oftentimes you might see like a large amount. You might say, hey, there's a large amount in like equipment expense or supplies expense, and you might say, well, that's something we should capitalize, and then you should basically capitalize. You may still get the full deduction this year due to the advanced depreciation methods. Also, just note that when you record this stuff, these are kind of like adjustments for tax and books purposes. You might want an adjusting worksheet just to depend on how much like the client wants information for their bookkeeping purposes. Do they want you to help them with adjusting journal entries and that kind of thing? And are they going to be on a tax basis or on a book basis for depreciation? So to do the taxes, all we have to do is take their information and then record the depreciation for taxes on it. But they might want book depreciation for their books. They might want adjusting entries, and the tax preparer often helps them to do that. Small companies may not care as much because they might just say, hey, I'm on a tax basis. Not a big deal. But if it's a large, as the companies grow, they're going to want more information, and they might want to be recording into this information into their software. You might want an adjusting worksheet to work with that. We have some other courses going over how to put together an adjusting entry worksheet for like businesses. We might go into that in a little bit more detail here, but just note that the depreciation is one of those adjusting entries that some people will want when you do bookkeeping for them. Or if it's a small business, you just kind of write it down. You take the income statement, you write down the adjustments on basically the bottom of the income statement, or do a nice little worksheet for yourself in the QuickBooks, in Excel, or something like that as well. So, but you want to document the adjustments from their schedule, because they will not have depreciation recorded on their side when you get the income statement, because they don't have the software to do so, at least not on a tax basis. So it will be different than what has been reported on the income statement you receive, and you're going to want to document then the adjustments that are going to be made.